mutual funds are investment instruments through which money is invested in the stock market according to the investment objectives of the mutual fund. Equity mutual funds are generally associated with higher risk, but they also offer higher returns, making them an excellent option for long-term investments. There are two ways to invest in equity mutual funds: lump sum or SIP, systematic investment plan. Let's say you invest 500 rupees in a mutual fund through SIP. Now, the mutual fund will allocate your 500 rupees across 50 to 80 different company shares, creating a diversified investment portfolio for you and reducing your overall risk. Generally, with 500 rupees, you might not be able to purchase stocks of even a single company directly. However, equity mutual funds give you the opportunity to become a shareholder in multiple companies with that same 500 rupees. The major difference between equity mutual funds and debt mutual funds is that debt mutual funds give you a fixed return while the returns of equity mutual funds fluctuate. The return of a debt mutual fund is much lower than that of a mutual equity fund, but so is the risk involved. Equity mutual funds can be divided into several subgroups, such as large cap mutual funds, mid-cap mutual funds, small-cap mutual funds, sector mutual funds, diversified equity mutual funds, dividend yield schemes, ELSS, equity-linked savings scheme, and thematic mutual funds. All of these categories are quite interesting and often distinct from each other in various aspects. Large cap mutual funds are mutual funds that primarily invest in companies with very high market capitalization. According to SEBI, Securities and Exchange Board of India, large cap companies in India are those that rank within the top 100 companies based on their market capitalization. These companies are highly reputable and have a strong track record of providing good and stable returns to their investors, which is why investing in them carries lower risk. Large cap funds are suitable for individuals who prefer to take lesser risks and seek moderate yet regular returns on their investments. Small cap mutual funds are mutual funds that invest over 80% of their assets in small cap companies. According to SEBI, small cap companies are those that rank below 250 based on their market capitalization and have a market capitalization of less than 500 crore rupees in monetary terms. Small cap companies tend to provide higher returns compared to large cap companies, but they also carry a higher level of risk. These mutual funds are quite sensitive to market ups and downs, which is why they are typically preferred by investors with a high risk tolerance and those who have confidence in the potential of these smaller companies to deliver good returns in the future. Small cap companies may also take considerable time to grow, which is why they are often viewed as long-term investments. Mid-cap mutual funds fall between large-cap mutual funds and small-cap mutual funds and offer investors several benefits as well as some drawbacks. Mid-cap mutual funds can be considered as the best of both worlds in a way. As the name suggests, these are mutual funds that invest their assets in mid-cap companies. According to SEBI, mid-cap companies are those ranked between 101 and 250 based on their market capitalization. Mid-cap mutual funds offer higher returns compared to large-cap mutual funds, but they also carry slightly higher risks. On the other hand, they have lower risk compared to small-cap mutual funds, but their returns are also relatively lower. Mid-cap mutual funds provide investors with various benefits of compounding, making them more suitable for young investors. Multi-cap mutual funds are those mutual funds where the fund manager has the flexibility to invest in any proportion of large cap, mid cap, or small cap companies without any compulsion to stick to a specific category. The fund manager is an expert who gets the opportunity to showcase their knowledge and capability through multi-cap funds. Due to their flexibility and potential for wealth creation, multi-cap funds are considered highly favorable and are often the first choice for many investors. Sector mutual funds invest in a specific sector of the economy, such as real estate funds, natural resources, etc. Each sector grows at different speeds at different times in the economy. In this regard, sector mutual funds provide investors with a good chance to invest in the best performing sectors and create short-term wealth. A very good example of this is the energy sector, where nowadays the increasing prices of petrol and diesel have become a cause of trouble for the governments and the people, while the mutual funds in the energy sector are giving record returns to the investors. One drawback of sector mutual funds is that since they focus only on one sector, when that sector experiences a recession, investors may have to bear losses. Therefore, it is suggested that people invest in sector mutual funds only when their investment portfolio is already sufficiently diverse. Diversified equity mutual funds are, in a way, the opposite of sector mutual funds. While sector mutual funds focus only on investing in a specific sector, diversified equity mutual funds provide you with the chance to invest in many different sectors. This allows for reduced risk and a more diverse portfolio. While sector mutual funds are good for short-term wealth creation, diversified equity mutual funds are considered excellent for long-term wealth creation. Diversified equity mutual funds are divided into three categories. Small cap diversified funds, which are high risk and high return funds. Mid cap diversified funds, which are less risky but whose returns also give less than those of small cap diversified funds. And large cap diversified funds, which invest only in those companies whose market capitalization is more than rupees 20,000 crores. The risk is very low in these, but they also give fewer returns as compared to the rest. ELSS funds are equity funds that primarily invest in equity and equity-related instruments. The most significant feature is that they offer a tax redemption of up to rupees 150,000 on your annual taxable income. You might be wondering why the government, which levies taxes on even a packet of chips, would provide a tax exemption to us. But it's true. Under Section 80C of the Income Tax Act, you become eligible for tax exemption if you have invested money in ELSS mutual funds. In addition to all this, any income earned through this fund is considered a long-term capital gain, and only a 10% tax is levied on it. Due to their many tax benefits, ELSS funds have become popular among people. However, before buying ELSS mutual funds, one should also keep in mind that they have a mandatory lock-in period of 3 years, which makes these funds less liquid. A dividend yield mutual fund is also a type of equity mutual fund in which investments are made in companies that declare dividends at regular intervals. The main objective of this fund is not the capital appreciation, but rather relies on the dividends distributed by the companies. It is evident that only those companies will regularly declare dividends that are earning good profits and have a healthy cash flow. Because of this, dividend yield mutual funds are considered quite stable. Thematic mutual funds are slightly different from other equity mutual funds because their focus is on a specific theme or idea. For example, a fund with the theme of infrastructure will invest only in stocks of companies related to steel, cement, construction, and similar sectors. Thematic mutual funds are more diverse than sector mutual funds, and because of this diversity, the level of risk in thematic funds is lower. These funds prove to be a better investment option for their long-term investments. Equity mutual funds offer higher returns compared to their types of funds, and their versatility attracts investors of all ages with diverse financial goals. Since debt funds carry slightly more risk than equity funds, some investors with lower risk tolerance prefer to invest in debt mutual funds. This helps diversify their investment portfolio and reduces overall risk. In the next episode, we will discuss debt mutual funds and their various types.